all eyes are on China at this stage, tightening monetary policy even further. In fact, that bank lending ratio by 50 basis points. But no surprise there, considering that the lending numbers for the month of January were at about $203 billion.
Yeah, and January was expected to be more than the previous quarter. So if you're having a look at some of the data that's flowing out from January, you're not surprised by these moves. And I would prefer to see monetary authorities on top of their game at this stage, and it looks like they are. They're obviously concerned that lending is becoming increasingly fast. But notwithstanding all these measures that they're taking, people are still expecting 11% growth out of China this year. So whilst there's lots of anxiety in the developed world and in the markets in our time zone in the US, the Chinese are still expecting to grow at 11% this year.
And a lot of worries about bubbles emerging in that region as well. So it's a good thing that they are trying to pull back on banks lending.
Yeah, that bubbles thing is interesting because if you mix people's propensity for gambling plus lots of free cash, plus a very small pool of assets in which to invest, you've obviously got quite a toxic cocktail, and that's why you see their equities market go up and down and up and down. But it's not people using borrowed money in order to fuel these prices that are growing, because debt ratios are still relatively low when compared to the rest of the world. And in fact, the Chinese are still bigger savers than they were a decade ago. But I read something interesting over the weekend in which Jim O'Neill said he thought there was something fishy at play here, where he thought this move was actually designed to weaken the Chinese currency by about 5%. So he thinks there's something interesting happening. There's some dynamics at play here which he hasn't seen before. So obviously the authorities wanting to weaken the currency a little bit, which goes against what the rest of the world want, of course.
Well, yes, everyone wants to see a stronger yuan, but on the other end, when we look internally into our own currency as well, there's a lot of concerns about it strengthening. Looking at the euro dollar, though, that's where the interesting play is happening right now, because it's not so much about dollar strength, it's about euro weakness. And of course, GDP out of Germany and of course Greece also came in slightly disappointing. So we are seeing quite a bit of pressure coming through on the euro front. What do you see playing out in the currencies at this stage, Sasha?
As did Italy, actually. Italy came below consensus. So you've got Germany flat. So there's real risk of a double dip coming sometime soon. It's interesting because I think the Greek debt situation is probably a little bit overblown, because if you look at the entire European Union economy, it's bigger than the US economy. And we're talking about 53 billion in the context of a GDP of the entire European Union of $16 trillion. So I think in the short term, whilst these anxieties remain, everybody is connected in some way. So the Germans and the French will have to step forward as the bigger economies inside of that zone in order to help the more marginal Mediterranean ones, such as Greece, such as Portugal. Spain is actually a much bigger problem. So I guess Spain will be the next one where people start to highlight and start to say, whoa, you know, perhaps there's some real structural problems here, because Spain, of course, have got an unemployment rate of 19%, I think it is.
Well, speaking of structural problems, when you look at Japan, fourth quarter GDP came in at 1.1%, better than expected. But we know one of the big issues that Japan has to deal with is, of course, deflation. And that problem has been around for many, many years.
Yeah, and I guess Japan is a working model of why not to keep interest rates low forever, because simply, you know, people don't, and it all boils back to, as you pointed out earlier, Chinese property bubble that happened in Japan in the late 80s, early 90s. So you're seeing asset prices not even at levels in the late 80s and the early 90s. So I guess inside of the developed world, the EU and the Fed have real working live examples of why not to keep rates low for an extended period of time, because suddenly you're forced into a corner and you can't raise rates because people are borrowing so heavily on your currency. It's a bit of a catch-22, but I'm glad, I guess, that you know, from the other countries. The thing that I think will save Japan ultimately is their proximity to China, and the fact that we have seen recent data that suggests that the Chinese are changing in terms of their own spending patterns, and they're becoming internal consumers. And as you know, a lot of Japanese companies have presence in China. The other problem, of course, is that the Japanese, they're getting far too old. And I think the average age of a Japanese person is 45. Now, can you imagine whereas in the most of Africa it's under 25. So they're going to be forced to perhaps change their labor practices, and I see over the next couple of decades have to import a lot of cheap labor, and as such perhaps change a big structural change in terms of their society, which will also lead to perhaps, you know, a lower GDP per capita, but ultimately that'll be what I think will save them.
Quiet trade in Asia this morning. Most bourses closed for Chinese New Year. Apart from that, we've got US markets also closed today. Sasha, what do you see happening for this week on the South African front, given the fact that we've got, of course, the budget announcement by Pravin Gordhan later on?
Yeah, I think inside of that budget announcement, and a lot of people have been saying, will personal income taxes rise? And I think they probably will have to in order to be able to fund quite a big shortfall. Now, whether or not that'll be once off or over a 2-3 year period, I think it could impact on the retail stocks or some of the banking stocks as you see towards the end of the week. So I guess to look out for will be, where are we going to collect more, and where are we going to apportion spending? Because of course the national healthcare system also needs to be implemented, and government's budget for healthcare is way shorter than I suspect what we need. In fact, by as much as 75-80%. So it'll be interesting to see allocation of resources in a very, very tough time. Now, I don't have a problem with the collection methodology. I have a bit of a problem with the way it's spent. And I think that's what everyone has highlighted. And we want to see more accountability.